So welcome to this week's video, and what we're going to do in this week's video is answer a query I've had from one or two people about basic stock screening. It's all very well knowing the sorts of ratios I've covered in earlier videos, but how do you put them together to start to weed out from a whole pool of stocks the ones you want and the ones you definitely don't want? Well, this week I'm just going to introduce one very simple screen. There are many others. It's a screen that's been used in the past by the likes of Joel Greenblatt, well-known investor, partner at Gotham Capital, and so on, and it's been used by one or two other people as well, with some success. And what it does is it puts together two ratios and asks a simple but crucial question. Is the stock I'm looking at both cheap, but also good quality? Cheap, defined as one ratio, good quality, defined as the second. Put those together, and can you start to screen for stocks that might be the best value investors' bets? Okay, so how does it work? Let's take a look at a very simple quadrant. Now, this quadrant works by basically saying, let's, in very simple terms, divide the population of stocks we're looking at into four potential groups, one of which we're most interested in, and the other three we're less interested in. Although in fairness, some commentators do argue about which quadrant is actually of most interest. But what are the quadrants? Well, I said to you that as a value investor, we're looking for stocks that are cheap. So how am I going to start to identify stocks that are cheap? Well, Joel Greenblatt favours a measure which compares enterprise value, that's the total value of a business, to something called EBIT. Earnings before interest and tax, also known as operating profit. I'll give you a few links at the end for those people who are brand new to this and not sure about the jargon. Okay? That essentially is a measure of cheapness. So the further up the scale you are, the more expensive a stock is getting, and vice versa. But we're not just looking for cheapness. Okay? We're not just looking for stocks potentially that have a low multiple of enterprise value to EBIT, sort of variant of the PE ratio if you like. We're also looking for stocks that can offer a decent and growing return. Return on capital employed, or ROCE. And the idea of a simple stock screen like this, okay, is that you can look at it and pick off the stocks that are both reasonably cheap, but also offer the potential to grow, okay, and weed out other stocks that may only offer one of those things or even neither of them. Okay? So let's go around the quadrant and see what we might be looking for. All right? Well, would you want, for example, to pick up a stock in this quadrant up here? Top right. Some people might say yes, you would, but actually the Joel Greenblatt approach says that's not necessarily your best bet, because you may be getting a stock up here which is good. It offers growth in return on capital employed terms, okay, but because it's up in this quadrant, it's also expensive. And as a value investor, you want to pay as little as possible for the growth that's coming in the future. Okay? So quadrant one isn't of most interest. So what about over here, the exact opposite? Now, people debate this quadrant here, but this suggests you're really scrabbling around amongst the grim stocks in a particular sector, because not only is the stock cheap, but it's cheap for a reason. Cheap and poor quality. It's not really delivering returns on capital employed as you'd expect. Okay? However, it is cheap in recognition of that fact. Now, bargain basement investors would say, well, that's where I want to be looking. Okay, there's probably some unearthed goodies lurking over in this quadrant over here. Okay, but I'm going to suggest that for now, that's also not the ideal place to go hunting. Okay, so what about up here? Up here you've got a funny old bunch of stocks, largely pointless bunch of stocks you might say, because up here they're relatively low quality in terms of generating return on capital employed, and they're expensive. Okay, so that's not going to give us much joy either. Low quality and expensive. Okay, no obvious reason why as a value investor you want to go hunting there. So that leaves one quadrant, and as I say, some people will debate this, but that's the point of these stock screens, is to allow people to sort of think about how you start to hunt down the stocks that you really want. That leaves one quadrant down here, where you've got stocks which are reasonably cheap, using my EV to EBIT measure, but could be potentially high quality. All right, cheap but offering return on capital employed. So cheap, and if we've got an upward trend in return on capital employed, growing. So maybe these are the beaten down stocks, okay, the ones that have been unfairly punished by the market in the past. They've got below EV to EBIT, but are now capable of generating decent return on capital employed. And the point is this, sooner or later everyone will cotton on to that fact. All right, sooner or later they'll probably move up into quadrant 1. I'm not saying they're going to stay here forever in quadrant 4, but that is where you might find your fallen angels, okay? Good quality stocks that are having a bit of a hard time, but actually have managed to turn the corner. Now, the ratio won't tell you how and why they've turned the corner. You've got to do more work. Okay, if stock picking was this simple, we'd all be making good money at it in very simple terms, but you've got to do more work. So why? Where's your evidence that there is growth coming through? Is it a new management team, new products? Is it simply that the market trashed everything in the sector and this one was unfairly punished and always had a good brand, good reputation? Are they pulling a deal that's going to change their fortunes? Okay, have they taken out costs that might be pulling up returns on capital employed, right? So there's more work to do, but Joel Greenblatt's saying that basically this is quite a neat way of at least starting to eliminate some of the stocks that you don't want, so you can focus more time and energy on the ones that maybe you do. What I've loosely called the kind of fallen angel stocks, okay? Now, I've covered quite a bit of ground in this very short video, so one or two people will be thinking, oh, I'm a bit lost, there's some terms there that you didn't really cover, and that's because they're covered elsewhere. So do feel free to take a look at my video. What is return on equity gets into the whole issue of what is return on equity and return on capital employed. They're not identical ratios, but that other video will give you a very good head start on how ROCE works. For those people a bit lost up here, when I started talking about enterprise value, do feel free to see my video, What is Enterprise Value, and a very similar video to what I put up here, What is EV EBITDA, which is a very similar variant of the ratio I've put here, okay? So, in summary, stock screens can be simple or complicated, right? They can involve 1 ratio, 2 or 6. Here, we've just looked at a couple that can be usefully combined into finding the best sort of value stocks in a particular sector or the market. Now, if you'd like to get my videos delivered free to your inbox on a Thursday before they hit YouTube, okay, plus a little extra bonus bit of jargon defined, do feel free to pop along to www.moneyweek.com/timratios. I look forward to seeing you next week.